Welcome to an important strategy session on investing sponsored by ProactInvest.net with Rich Wiegand entitled, Should I Have Convertible Bonds in My Portfolio? This lesson is downloadable on the ProactInvest.net website as a PDF document and as a video tutorial and is one of the chapters in an ebook entitled A Practical Guide to Investing Safely and Wisely. We welcome your questions and feedback via comments on the ProactInvest.net website as well as on Facebook. Please like us on our Facebook page as well as helping to spread the word on YouTube by liking us and subscribing there. Let's review some of the key questions that we'll be covering in this strategy lesson. Convertible bonds are just one among many of investment choices. We have to understand what they are and what makes them tick before we consider investing in them, either directly or through mutual funds or ETFs. Yes, there are ETFs that are comprised solely of convertible bonds. We have to also review how this bond sector has performed compared to other bond funds based on historical data to determine whether it's really worthwhile going down this route as investors. Convertible bonds, converts or CVs for short, are hybrid securities. They're part bond and part equity call option. Like most corporate bonds, converts typically pay semi-annual interest based on a coupon rate until the maturity date, at which time the principal is repaid to the bond owner in full. The coupon rate for converts is actually noticeably lower than for non-convertible bonds because the company is granting the convertible bondholder a privilege or right to convert the bond into shares of common stock at a predetermined, usually higher than current price per share for the life of the bond. In effect, this right to convert into common shares is an equity call option. So convertible bonds may be viewed as being a lower yielding corporate bond combined with an equity call option on the company's common shares, a contractual agreement that is valid until the maturity date of the bond. In return for a somewhat lower yield on the bond, the company issuing the convertible bond is giving the bondholder the ability to participate in the upside potential of the value of the firm, assuming that the stock price rises over time. If the stock price does not rally and goes down instead, then the equity call option component becomes worthless, in which case the convertible bond is simply the value of the outstanding debt portion. Why do these hybrid securities exist? How and why were they developed? They exist because they offer specific advantages to the companies issuing them. If a company wants to raise capital to help pay for an expansion or for everyday operating expenses, convertible bonds offer cheaper and lower financing rates than non-convertible bonds because of the equity conversion call option privilege granted to bondholders. The further out the maturity of the bond is, the more time value the call option has and the lower interest rate the company has to pay for borrowing money. The company is not diluting the common shares outstanding by issuing convertible bonds because the equity options attached to the convertibles are exercisable on existing, that is, already issued common shares of stock. Therefore, the earnings per share and ownership value per share of the company are preserved. They're not diluted. From the investor's perspective, converts offer the protection of a senior security. If the company should go belly up, bondholders get a piece of the carcass before equity shareholders do, and that includes convertible bondholders. Converts are subordinate, however, to senior indentured bonds. Converts have higher coupon yields than the dividend rate on the common shares of stock, if a dividend is even paid on the common shares. And as we said, converts also participate in the upside value of the firm should the stock price rally over time. Because of the equity component, the average annual total return of converts is about 2 to 4% higher than your typical investment-grade bond fund. Converts are also more actively traded than corporate bonds, making them highly liquid. However, as I mentioned in another ProactInvest lesson on investing, I totally discourage investors from buying individual bonds in general. It's much, much safer and more prudent to get the diversification that a well-managed bond fund offers than to try to construct and manage a portfolio of a handful of individual bonds by yourself. Some of the disadvantages are quite significant to owning converts. First, because of the equity call option privilege, converts pay a lower interest or yield than non-converts. But the major negative for converts is that they behave more like stocks than bonds, and so exhibit about 3 times as much volatility, that is downside risk, as plain vanilla investment-grade bonds do, and about 2 times as much risk as a high-yield corporate bond fund does. Let's step back and have a look at the total return chart from Morningstar that compares Vanguard's convertible bond fund with Vanguard's S&P 500 index fund and Vanguard's intermediate investment grade bond fund. The practical question is, do converts behave more like stock or equities than like bonds? A fast and easy way to answer this question is to go to a chart like this one on Morningstar and overlay the total return performances, which includes dividends plus capital gains or losses, of a convertible bond index fund, in this case Vanguard's Convertible Securities Fund, ticker VCVSX, with the S&P 500 fund managed by Vanguard, ticker VFINX, with an intermediate bond index fund like Vanguard's VFIIX. When we do this, you can clearly see that the convertible bond fund, the blue line, behaves much more like the orange line than the green line. The green line, again, is the intermediate bond index fund managed by Vanguard, VFIIX. The blue line is thus more correlated with the orange line than the green line. This should raise a red flag to investors because stocks are about 4 times as volatile as investment grade bonds. So right off the bat, we know this means that the orange line is about 4 times as volatile as the green line. But we have to be very careful with this type of animal. Converts are not the silver bullet for our portfolios after all. In defense of converts, however, we notice that they did rebound better from the depths of the financial market meltdown in 2008, as we see here, than did the stock market itself. But the green line, the investment grade bond fund VFIIX, hardly didn't suffer any pain at all in 2008. In fact, it even went up. It finished the year positive in 2008, which is amazing considering that we were in a global financial crisis. Here's another chart from Morningstar.com showing the high correlation of convertible bond funds and the S&P 500, the stock market. Notice the high correlation that the converts have with the stock market. How bad exactly was the fall in value for 2008? While the S&P 500 lost 37% of its value, the Vanguard Convertible Bond Fund was down 34%, 34.8% to be exact. Meanwhile, the investment grade bond fund actually made from plus 5 to 13% in 2008, depending on how much U.S. Treasury exposure it had. The bottom line is that convertible bond funds do not preserve capital in equity bear markets, and they're about as risky as stock. Over the past 10 years, convertible bond funds performed about as well as high-yield bond funds, but dropped about 9% more than the high-yield bond funds did in 2008. The risk for convertible bond funds in terms of annualized standard deviation, a measure of volatility, is about 16.6% versus 11.6% for the orange line for high-yield bonds. So if convertible bond investors ended up about where high-yield bond investors did, but suffered through 9% more risk on the downside in 2008, and on average about 5% more risk in general, in terms of volatility and standard deviation, then why bother with convertibles at all? Are convertible bonds really worth the added risk? We see once again the historical performance of the Vanguard Convertible Bond Fund, VCVSX, the blue line, versus the Vanguard High Yield Bond Fund in yellow, ticker VWEHX, the Vanguard S&P 500 Index Fund, VFINX, the orange line, and the Loomis Sales Bond Fund in green, ticker symbol LSBRX. Notice how the Loomis Sales Bond Fund, which is a 5-star investment-grade bond fund, it's a managed blend of investment-grade and high-yield bonds, outperformed all the other bond funds on this chart over the past 10 years and suffered much less pain than all the others did in 2008. There are a few other bond funds like Loomis that I can recommend as well, but none have the equity-like juice that Loomis offers. In equity bull markets, Loomis ups its exposure to bond sectors that have more equity-like characteristics, like convertibles or high-yield debt, but never to the point where they dominate the overall portfolio. Indeed, Loomis offers exposure to convertibles too, but this exposure rarely exceeds 10% of the overall allocation. High-yield debt is also kept in check, so that a base of around 70% of the portfolio is always in safe medium duration, that is 4 to 8 year maturity investment-grade bonds. So Loomis offers a well-managed, flexible solution for conservative investors who don't want to lose their shirts in bear markets, but who still want to benefit from bull market rallies. This table compares and ranks conservative, plain vanilla investment-grade bond funds like AGG and VFINX with those of increasing equity exposure like Loomis and Vanguard High Yield and Vanguard Convertible. The more equity-like characteristics, as in the case of high-yield debt and convertible bond funds, the higher the risk, as measured by standard deviation in this case. Based on historical data for the S&P 500 stock index going back to 1926, stocks have an annualized standard deviation or risk level of 20%, about 4 times that of the Barclays Aggregate Bond Index, ticker AGG, of 5%. Converts come quite close to the pure stock risk of the S&P. They have about 17% risk compared to the S&P's 20%. The quick-Sharpe ratio is a useful measure of gauging the amount of reward in terms of average annual total return divided by volatility, or the risk that you assume to get that return. So it's reward divided by risk, and that gives you the quick-Sharpe ratio. As this table shows, investment-grade bonds have some of the highest Sharpe ratio that you can get across any asset class, whether it be stocks, bonds, commodities, or real estate. The only major drawback that investment-grade bonds have is their comparatively low average annual rates of return. Take the Barclays Aggregate Bond Index, ticker AGG. Its average annual total return is about 6.1%, which is about 3% above the rate of inflation in this country historically. So if we need a little more extra kick, you can get that from a bond fund that pays a higher yield but also has higher credit risk, or has exposure to bonds with equity-like components or features like convertible bonds. Or you can choose to invest in a fund like Loomis Sayles, ticker LSBRX, whose managers know how to get the right mix of safety and higher yield and or equity upside. Longer-term investors definitely want to have more equity exposure and higher yield than investors with a shorter time horizon. But as you'll see in later lessons, you should not raise your equity exposure with either stock funds or bond funds with equity components beyond a certain manageable level. In later chapters, I'll show you a suggested equity allocation for most long-term investors and which funds to choose. This bar chart shows the average annual percentage returns, black lines, for all the bond funds that we discussed in this lesson. But it also shows their best and worst annual performances since inception. As you can see, the riskier funds generally have the widest swings. That is, they have the highest best years, but they also have the worst years. As with the Q-Sharpe ratio that measures reward divided by risk, investors want to get as much green as possible with as little red, and also have a pretty decent average annual total return. Investors must try to outperform the rate of inflation of 3% historically in order to generate real returns. Based on these reward to risk measures, which bond fund would you opt for? The bottom line is that investors are advised not to invest directly in convertible bonds or bond funds. Reward to risk ratio comparisons show that there are better options available. While the Loomis Bond Fund, LSBRX, is riskier than the Janus Flexible Bond Fund, ticker VFINX, or the Barclays Aggregate Bond Index ETF, ticker AGG, it does generate an average annual rate of return of around 10%, which is outstanding for a bond fund that typically holds close to 70% of its portfolio in safe investment-grade bonds. The rest of the Loomis fund is invested in higher-yielding debt securities, preferred stock, and/or convertible bonds. At the time of this report, about 10% of Loomis is allocated to convertible bonds. The point is that a diversified, predominantly investment-grade bond fund like Loomis will give you the equity exposure and higher yield that long-term investors need, and it does so within the right proportions. I'm not suggesting that investors allocate everything to Loomis, because I recommend that you balance Loomis with a more conservative fund like Janus Flexible, VFINX, or even the Barclays Aggregate Bond Index, ETF, AGG, while allocating a small percentage to stock funds. I'll cover my suggested all-weather long-term investment portfolio in a subsequent chapter of this book, which will have the recommended weightings for each fund. This concludes the chapter of the book, A Practical Guide to Investing Safely and Wisely on Convertible Bonds. If you enjoyed this strategy session, please help spread the word to your friends on Facebook, Twitter, StumbleUpon, by email, or simply by word of mouth. Please remember to check out our upcoming ebook on investing entitled A Practical Guide to Investing Safely and Wisely with complimentary video webinar series. Thanks so much for your attention.